Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, November 14th, 2023. Hope everybody's having a fantastical day out there in the interwebs. It's a beautiful day here in Colorado, and let's see, lots of sun. It's not too hot, and just an all-around good day. So, again, hope everyone out there is having a nice day, too. Looks like the markets were in a good mood, got a good CPI or inflation report, and everyone was like, whoa, the market's heading north. So, unfortunately, I got some bad news or an article to cover that, unfortunately does not have the good news everyone's hoping for. So anyways, all righty. Well, let's go ahead and let me refresh that screen so it looks good. Oh, now it's giving me the pop-up blocker. Come on. Well, we're going to sit here for a second until the pop-up blocker goes away on the screen so we can see everything. Come on. Of course, I'm on TV, well, the internet, and, it's not cooperating. Come on. Let's restart that one more time. All right, I'm just going to turn it off. Pause and refresh. There we are. Okay. All right, well, let's go ahead and get to the indexes for today. God, technical difficulties everywhere. All right, close that down. All righty, Dow Jones was up 1.43% today, 489 points, closed at 34,827. S&P 500 was up 1.91%, closed at 44.95. NASDAQ up 2.37%, closed at 14,094. The VIX fell 4.07% today. It's down to 14.16. Canada was up 1.6%. Brazil was up 2.31%. And Mexico up 2.76%. Over in Europe, Germany was up 1.76%. The UK up 0.2%. France was up 1.39%. Where were we? Netherlands up 0.73%, Spain up 1.71%, Italy up 1.45%, Switzerland up 1.18%, and Portugal up 0.62%. Russian exchanges both red, MOEX down 1.1%, and the RTSI flat down 0.04%. And the overnights in Asia, the Nikkei in Japan was up 0.43%, Australia up 0.83%. In China, the Shanghai was up 0.31%, the Shenzhen Component up 0.17%, China A50 up 0.02%, so flat. DJ Shanghai up 0.32%, Hang Seng down 0.22%, and the Taiwan weighted was closed. All right, let me resume that. All righty. So it looks like I said, especially here in the domestic markets in the United States, things were in a good mood because of that CPI print came in a smidge lower than what they were hoping for. So again, I don't know why that's super exciting. We still have all this built up inflation that we've had for the last 2 to 3 years. And I haven't seen any deflation. Have you? I haven't seen any out there. All right. Let's go ahead and get to today's market recap. U.S. stocks jump as cooling inflation boosts. Fed bets Fed rate hikes are over. I don't know. All right. U.S. stocks surged on Tuesday, buoyed by a significant drop in Treasury yields as October's consumer inflation cooled more than expected. The Consumer Price Index, the CPI for October, registered 0 down from the prior month's 0.4% and below economists' predictions of 0.1%. This unexpected deceleration reinforced investor expectations that the Federal Reserve's tightening cycle might be coming to an end. Morgan Stanley noted in a Tuesday report that the soft inflation, particularly on the services side, coupled with still tight financial conditions, is likely to keep the Fed on hold. Traders are now anticipating the Fed to maintain interest rates and potentially implement a rate cut in May, according to Investing.com's Fed Rate Monitor tool. In response to the inflation report, Treasury yields experienced a sharp decline, with the 2-year Treasury yield dropping by 21 basis points to 4.832% and the 10-year Treasury yield falling by 18 basis points to 4.455%. Big tech companies, including Alphabet and Meta Platforms, saw a more than 2% rise, benefiting from the dip in Treasury yields. The broader tech sector also received support from a 3% surge in chip stocks, driven by positive sentiment around Global Foundries Inc., Novanta Inc., and Marvel Technologies. Marvel Technology received a buy rating and a $60 price target from Roth MKM, citing the chipmaker's favorable position to benefit from artificial intelligence. Home Depot led big box retailers, rising over 6% after reporting Q3 results that surpassed Wall Street estimates. Target is set to release earnings on Wednesday, followed by Walmart and Macy's on Thursday. Energy stocks, despite rising oil prices on a stronger demand outlook, lag behind the broader market move higher, with the International Energy Agency, the IEA, raising its 2023 growth forecast in its monthly report. The Organization of the Petroleum Exporting Countries, OPEC, also slightly increased its 2023 forecast for global oil demand growth. Well, the 2024 forecast for global oil demand growth. All right. So everyone's in a good mood today for now. So we'll see what happens. All right, let's dig into the inflation numbers a little bit. Inflation slows to 3.2% in October. Let's see what the numbers say there. All right, headline inflation in the U.S. showed a greater than expected slowdown in October, providing a positive development for the Federal Reserve officials aiming to manage price pressures. The U.S. Consumer Price Index from the Labor Department revealed an annualized rise of 3.2% in October, down from 3.7% in September, primarily driven by a decline in gas prices. Not around here. This marked the first decrease in the yearly reading in 4 months. On a monthly basis, CPI was unchanged, contrasting with the previous month's increase of 0.4%, and the figures were below economists' expectations of 3.3% annually and a 0.1% monthly uptick. The Fed has been actively pursuing interest rate hikes to bring inflation back to its 2% target rate. The latest CPI figures, signaling a renewed cooling in price growth, are likely to be welcomed by policymakers. The core CPI, excluding more volatile items like food and energy, increased by 4% annually and 0.2% monthly, reflecting a slower pace than anticipated. However, concerns about lingering inflation stickiness have led some policymakers to suggest that current interest rates might not be sufficiently restrictive, and that's in quotes, to achieve the 2% target. Fed Chair Jerome Powell emphasized last week that the central bank would not hesitate to raise borrowing costs further if deemed appropriate. Following the release of the data, U.S. stock futures surged while Treasury yields, which usually move inversely to prices, declined. So, yep, everyone's, like I said, in a good mood. Inflation is gone. Poof. Yeah, right. Anyways. All right, I got one last article here. It comes from Yahoo Finance. It's titled, Recession Will Hit the U.S. in 2024, so get ready for massive interest rate cuts, UBS says. So let's see what UBS has to say about where we're headed. All right. UBS is forecasting a U.S. recession in 2024, leading to a significant response from the Federal Reserve, including a steep interest rate cut of 275 basis points. That's 2.75% for you normal people out there. This projection far exceeds the 75 basis point reduction currently expected by the market, according to the CME's FedWatch tool. Excuse me for a second. UBS anticipates the recession in the second and third quarters of 2024, prompting the Fed to implement substantial rate cuts as a response to falling inflation and economic slowdown. The bank's team, led by economist Arind Kaptian and strategist Bwanu Bawaje, expects rates to drop to 1.25% in the first half of 2025. That's some wishful thinking. Since March of 22, the Fed has increased borrowing costs from near zero to approximately 5.5% to combat surging inflation. Let me stop here. What do you think cutting rates by 2.75% is going to do? Do you think they're not going to do any spending along the way? Sounds like an opportunity for more inflation. All right, where was I? Although the inflation hit a 4-decade high of 9.1% in June of 21, it has since moderated, remaining well above the central bank's 2% target. Despite the tightening campaign, the U.S. has avoided a recession somehow, with GDP expanding by 4.9% in the third quarter, marking its highest growth rate in 2 years. Excuse me. UBS's recession prediction contradicts a separate outlook presented by Jason Draho, UBS's head of asset allocation for the Americas. Earlier this month, Draho highlighted the U.S. economy's surprising resilience in 2023, suggesting that it had set the stage for the Roaring '20s period, characterized by higher GDP growth, inflation, high bond yields, and interest rates. Doesn't that sound awesome? Everything's going to be expensive through the next Roaring '20s. Woohoo! Does that mean we're going to have prohibition and I can do like my great-grandfather did and bootleg alcohol from Canada down to Chicago? Anyways. All right. Well, that's everything I had for today. Hopefully today's good news maybe carries us to tomorrow. I don't know. Tomorrow's a new day. We may have some more bad news and the market go back the other way. So anyways, all right. Well, that's, like I said, everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. You can see my boy Jake. He's ready to go play some ball outside. It is beautiful. So we're going to go play while the sun is still hitting my driveway before it gets too cold outside. So hope everyone has a wonderful night, and I shall talk to you guys next time. Adios.